All right, hello everybody. This is Mike Rixey with NetPicks, and in today's video, I want to take a look at how the upcoming tariffs could potentially change market conditions. I've talked to a lot of people here over the past few weeks that are concerned with trading conditions changing, with the economy as a whole taking a hit as well. So I want to walk through some steps that you should be taking now to get prepared for what's to come here in the weeks ahead. So let's dive in and let's start out with the chart of the S&P 500 ETF. This is symbol SPY. Notice how it has been a noisy stretch here the last few weeks. We had the initial push to the downside as traders started to digest the uncertainty around the tariffs. We've had some attempts over the past few weeks at markets bouncing, but prices had a really hard time getting above some of these key areas of resistance. There's still a lot of uncertainty out there. Hopefully we'll get some clarity here over the next few days, but what I don't believe is going to happen is I don't think we're going to go back to what we saw last year. If I zoom out, just see that incredible run to the upside where day after day, week after week, it was new all-time highs. We're not going back to that anytime soon. I do believe we're in for a continued stretch of volatility. So there needs to be some steps taken now to adjust for that. And there's some things that I've done on my side. Diversification is so crucial, but I'm not talking strictly about just mixing up your markets. As an options trader, we have the flexibility to use different options strategies. Now is not the time just to swing for the fences across the board and just buy outright calls and puts on everything on your list. I think now is a prime time to use a mix of strategies, including credit spreads. Take advantage of the high volatility, collect more premium up front, and set yourself up for a higher probability of success. Take some pressure off needing to pick the next washout move to the downside or the next historic bull run. Take the pressure off and focus on strategies that are going to give you multiple ways of making money. And I'll circle back to that in just a moment. Now, on the upside, for the bull picture to be repaired, for us to see a more of a sustained trend to the upside, a couple levels that I'm watching for the next few days. 568.88 would be a key level that would need to break on a closing basis. If that does break, I could certainly see more follow through on the upside in the near term. I don't expect anything sustained. I don't expect us to settle into a trend for weeks on end. I would expect a break of that level, potentially get up and test some of these upper moving averages right around that 580 level, and then potentially roll back over, right? On the downside, there's a couple areas to watch. First of all, bring my data box up. The 8-period exponential moving average, which is sitting right at 563.30. That level has been tested multiple times over the past few weeks, and you can see just about every time it's been tested, price has rolled back over. It's had a hard time breaking up through that level on a closing basis. So that's one to watch. If we break back to the downside, we've got this low from back on March 31st at 546.87. And then if I zoom back out, we've actually got a swing level from September of last year, right around 540. That could come into play. Those would be areas of potential support where I would expect the bulls to step in and potentially buy the dip there. Now, how has the whole tariff uncertainty, how has it impacted markets in the near term? Well, if I just take a look at the past few weeks, look at the volume. The volume has drastically improved. We have been pretty steady between 60 and 100 million shares on a daily basis on SPY. That's a great thing to see. That makes life easier for us as options traders. It's going to be easier for us to get fill prices, good fill prices, that is. So the volume has been very good. And look at the ATR. The average true range is at 9.71. A good range for us, we like to see between 6 and 8. We're above that. Markets are incredibly active. So I hear from a lot of people right now, should I just go to the sideline? Should I go to cash? Well, it depends on what your time frame looks like. If you are a long-term buy and hold investor, probably not a bad idea to play it more conservative at this point. Play it safe, maybe go to the sidelines, hold off on putting new capital to work. But if you're an active trader, and what I classify an active trader is holding anywhere from 24 hours on out to 2 weeks, this is really ideal. You couldn't ask for much better trading conditions than what we've seen the last few weeks. Very active ATR, very good volume. The VIX, or the volatility of the S&P 500, if you take a look at the market-wide volatility, we're upwards of 21, 22 at this point. That's a great number there as well. That just indicates there's a lot of back and forth movement throughout the trading session, and you'll see it throughout the week as well. There's a lot of opportunity in both directions. Now, do you need to be open to trades in both directions? Absolutely. If you just take a look at this daily chart, right? We've had a big move lower, we've had a nice recovery, rolled back over to the downside again, and now we're trying to recover yet again. There's moves in both directions. You want to be cautious falling in love with one side, where you just fall in love with, hey, I'm only going to take a bullish trade or I'm only going to take a bearish trade. Be open to trades in both directions. There are opportunities in both directions. Way too many retail traders right now are saying, hey, I can't take a bullish trade right now. I'm very bearish on the market going forward over the next few months. And my pushback to that is you can certainly lean bullish if you're just base, right? If you take a look at this last 3-day window here, there's been a lot of opportunity on the upside. There's been bullish opportunity there. So I would rather have you look at some of those shorter duration trades, right? Look for the next couple of days as a holding time versus the next couple of months. We can always cross that longer term bridge when we get to it, right? The shorter term trades definitely more conducive for what we're seeing in this market. But if we switch this from SPY over to the VIX, volatility, if you turn on financial media, you turn on the news. I mean, everybody talks about volatility being a bad thing. When the VIX starts to get high, everybody runs to the sidelines. Well, I take a look at these expansions here that we've seen on this VIX chart. Right? If you take a look last summer, we had a big expansion in volatility. And since then, if I zoom in a little bit, you can see, get that data box out of the way. You can see as I scroll back, we have definitely had some stretches here where a couple days, couple of weeks, volatility starts to expand and you get these waves to the upside. Oftentimes, volatility gets overstated. Markets price in an extreme level of fear, expecting the worst. And then when the worst doesn't play out, markets start to normalize, right? And you start to see that volatility come down. When volatility gets elevated like it is now, it makes it more difficult to just strictly buy long calls and long puts. Everything becomes more expensive. You're paying more for those long options. It can work, but more pressure is put on needing to be right on the timing of that trade and also needing that directional move to be big enough to offset, the more expensive options, to offset any time decay that's there. You need more to go right in your favor. When I see stretches like this where you have the VIX, in the upper teens to low 20s or even above, that's a sign for me to lean towards more credit spreads. Doesn't mean you have to abandon buying options. I just don't want that to be my core strategy that I'm depending on for my consistent source of income. The credit spreads are going to give up the home run profit potential, but they're going to give you a much higher success rate, a more forgiving trade where the pressure is not so high on needing everything to fall into place perfectly. All right. So volatility being elevated, again, that is not a bad thing. As an active trader, you want the volatility, you want the volume, you want the range, and we've got all that right now. So is now a time to just run to the sidelines? In my opinion, absolutely not. I think you're making a big mistake if you do that. Now, what does a credit spread look like? What am I talking about here? Well, if I just take a look at a chart of Spotify, this is the 130-minute time frame. We're seeing more and more charts with this type of pattern. It's coming off of a stretch where we've had some big movement. We just took a look at that daily chart of SPY. We saw those moves back and forth, but now we're starting to see Spotify and many other names settle into a range here. We're settling into that sideways stretch. Now it's probably building energy for the next move. At some point that range is going to want to break. We just don't know when that's going to happen, nor do we know in which direction it's going to happen in. So in this case, what I saw here, when we sent this trade out to our members here, over the past few weeks, we had yellow popping up on our pulse indicator. Those yellow bars right there indicate that price is between a 1 and a 2 standard deviation move on the upside. It doesn't mean price can't move higher. It just means it's not statistically probable. Only 13.6% of all occurrences fall outside of that range on the upside. So look what's happened to price since we saw the yellow pop up on the pulse. We've seen price move sideways. It's drifted to the downside. But it hasn't been anything earth-shattering. We haven't seen a big directional move. It makes perfect sense. The market had already made a big move on the upside. We got overbought. That gives me the signal to lean more towards the bearish side. But I don't just want to come in and buy a long put. Again, I just need too much to go right. I need the stock to move lower. I would need it to happen quickly. I don't want to be that aggressive. So what we did with our members is we came in and we sold the 600-605 call spread. Collected $182 per spread. Tied up $318 of our capital per spread. That's a fully risk-defined trade, right? So now instead of just buying a long put, tying up more capital, only having one way of making money, I'm drastically cutting the cost of the trade on Spotify down to only a few $100s. And if I'm dead wrong, the most I can lose is $318. And I can only lose that entire $318 if I hold all the way up to expiration and the trade goes against me the entire time. I can always close it out early and take a partial loss if needed. We had 5 ways of making money on this position: up, down, or sideways. As long as price stayed below our short strike at 600, I was okay. We also made money from time decay adding up and from volatility decreasing. Now I had 5 different routes to follow on this trade to make money. Did we get a big move to the downside? It moved lower. Wasn't anything huge, but we didn't need it to be. Got a little bit of a push to the downside. We had time decay adding up in our favor, and we had a little bit of volatility contraction. Nothing huge, but remember, I don't need all 5 factors working out in my favor. In this case, we were in and out in 5 days. Closed it out for 90 cents. It gave me a $92 profit per spread. That's a 29% return on my capital in 5 days. I checked in on this one 10 minutes a day or less. Right? So now a 29% return in and out in 5 days with a fully risk-defined trade. That's why I love having these credit spreads in my toolbox. Again, does not mean I recommend completely going against just buying long calls and long puts, but if that's all you're going to do, you're going to have more volatility in your equity curve. I would rather have you use a mix of strategies, right? Some credit spreads, some long options, some weekly options, some monthly options. This spread that we have up on the screen, this is with a monthly cycle with between 20 and 40 days left to expiration. I've also taken trades here recently with some very short-term weekly options. Mixing it up, getting more layers of diversification can certainly be helpful in the stretch where we have all this tariff uncertainty. I don't see that changing anytime soon. You want to put some of these steps in place now to better prepare yourself for what's ahead. Now, let's talk about position size. Another step you can take is to cut back on your size. I see too many people right now swinging for the fences, not only with their strategies, but with their position size. Right? Just going all out, putting everything they've got into 1 or 2 big trades. And I understand if they hit, if they win, you're going to look at some really game-changing profits. But what happens on the flip side if those trades lose? I don't want you in that large drawdown. I don't want you to wipe out an account. It's very easy to do in this market. If you're using proper position size, what we consider proper, between 2 and 5% of your account per trade. Now, if I have a losing trade, it's not going to wipe me out. It's not fun, but it's part of trading. We're always going to have winners and losers. If I can keep those losses small, I can live to fight another day, and I can trust that those numbers are going to work out in my favor long term. So really check your size. Don't get overly aggressive thinking, hey, if I don't get big with my size, I'm going to miss out on a once-in-a-lifetime opportunity. You're not. Markets are active. Markets will be active for various reasons in the months and years ahead. Right? Don't fall into that trap of that fear of missing out impacting how you're trading and how you're using position size. Now let's talk about markets. I see a lot of people talking about, what markets should you be trading with all of this uncertainty? What markets are going to potentially benefit the most or be hurt the most from these upcoming tariffs? Well, I push back on that a little bit. And what I don't want to do is just chase recent performance or chase headlines. What I'm looking to do is really simplify my universe where I'm looking at the same watch list of products consistently day in and day out. I don't like to run scanning software where I'm looking at hundreds or even thousands of markets on a daily basis because you're going to be left in many cases trading names you're not familiar with. It can be the greatest looking chart pattern in the world, but if it doesn't have liquid options, if it doesn't have tight markets, it's going to be a hard market to trade. What I would rather do, I've got 15 markets up here on the screen, and notice we've got a lot of the heavy hitters here, and that is by design. We've got some tech stocks here. We've got the index ETFs. We've got 2 of the metals, gold and silver. I've got some energy products, some financials. I'm trying to give you a really concise list. It's not, all-encompassing. We're not looking at hundreds of markets. We're looking at the markets that we know, whether it's a tariff market, whether it's the Fed moving interest rates in the months ahead, whether we're going into earnings season. These are names that are going to be consistent week in and week out. If you take a look at Apple, Amazon, SPY, QQQ, if I go over to the trade page and look at some of these, look at SPY. If we open up any of these option cycles, we literally have volume and open interest in the thousands of contracts. These are very, very liquid markets. Apple, one of the most liquid markets in the world. When you get into a market like this, that's all over the map. Volatility is active, range is active. You want to go to where the activity is at. You want to go where markets are tight. Look at Apple. There's a 5-cent difference between the bid and ask prices. I can pretty much do anything I want in Apple and get filled pretty quickly and at good pricing. Those are the markets I want to look at. If we take a look at that watch list again, if you go through it and you take a look at NVIDIA, or if you take a look at Amazon, are these markets that are only going to be active in this 1-month window with the tariff uncertainty? They're not. These names are going to be active regardless of what the news cycle is telling us, regardless of what markets are going to do. They lead on the upside. They can also lead on the downside as well. These are markets that you can go to if you're crunched for time. If you don't have a ton of capital to work with, utilize those credit spreads on this small list of products. It's going to give you plenty of activity, and I think there's potential in so many areas here. Gold and silver has been dynamite for us. The tech stocks, phenomenal. If you're looking for a list of go-to markets, these 15 markets right here on my screen, it's a great starting point. These are going to keep you, allow you to grow your account even with the market uncertainty. So just to summarize here, really mix up your strategies, diversify not only with the products that you're trading, but also with the strategies. So some long options, some credit spreads, some weekly options, monthly options. You can do so even if you have a small account. A lot of these credit spreads, we're talking about a few $100s of capital or less, right? So we can definitely add in different layers of diversification. Don't overtrade. Don't use the large position size. Cut that back. Make sure you're risking between 2 and 5% of your account per trade. If you can do that, you're really going to improve your consistency over time. It's going to be easier for you to stay disciplined and not let those emotions take over and dominate your trading decisions. So if you have any questions at all, feel free to comment on the video. We'd love to connect and help out. We do have some tools here that we can certainly help get you on the right track with. So leave a comment, or you can always email us info@netpicks.com, and we'd be glad to help out. All right, so I'm going to wrap this video up here. I'll be back with you guys over the next few days, and we'll talk through some specific trade examples of trades that are potentially popping up on our radar, trades that we're going to be taking here on our side. So enjoy the rest of your day, guys, and we'll talk to you in the next video.
Everything discussed here is our opinion, and it is not to be taken as investment advice because we are not your financial advisor, nor have we considered your personal situation as your fiduciary. This presentation is for your education and entertainment only. Please review NetPicks' full risk disclaimer and privacy policy.